Hello, hi, Jerry Miller here from Trendsignal, the trader education company. Today we're going to have a look at currencies. There's been some interesting moves, specifically in the US dollar and actually sterling, the much maligned sterling. So I'm going to kick off this week's discussion by asking the question, why is the US dollar falling? Um, Most economists have continued to say and would agree that the US dollar is overvalued probably by about 20 to 25%. But it's been like that for more than a year or two, in fact, longer than that. And as an argument for trading, it's a particularly poor one because you'd have got on the wrong side of it last year. And it certainly doesn't stop it appreciating further against other majors. Also, being the world's reserve currency means that the US dollar tends to be in demand almost all of the time. Um, Interest rate levels or interest rate differentials play a key part. And what I mean by that is the uh, difference in interest rates between the US dollar and its major competitors like the Eurozone, UK, Switzerland, Japan, and then the minor ones after that. Um, just to put you in the picture, the Fed moved to raise interest rates a lot more aggressively early last year than other central banks. At the beginning of the year, this time last year, in fact, the European Central Bank, Christine Lagarde, its president, said that she didn't see the European Central Bank raising rates in 2022. There was a quick sea change, obviously after the Ukraine war started when Russia invaded. But so there's been a lot of catch up there, but it doesn't explain the fall in the US dollar over the last 6 months, really. Um, there has been a softening of interest rate expectations with the forward rates that you can track actually on the Chicago Mercantile Exchange. They've sort of eased a little bit, but the market rates are actually at odds with Fed thinking. Forward rate contracts traded on this exchange expect rates to peak at 4.75% to 5%. They're currently at 4.25%, and we're expecting two rate rises, one in the meeting next week, on the 1st of Feb, and then another one in March, which will take it up to the rate up to 4.75%. And that's what market participants think will be the peak in rates this year in the US, with a possible cut in November. That actually doesn't chime with what Fed officials are saying, and Leo Bernard, who was at the World Economic Forum, was at pains to say that the Federal Reserve and its rate setting committee, the FMC, would stay the course. So there could be some interesting developments this year that may put the Fed more aligned with the markets, or more importantly, the markets may align with what the Fed is thinking. Anyway, the more interesting effect on the US dollar is the more optimistic mood in global markets. When we sort of finished for Christmas and the New Year in December, the mood was a little bit somber. I don't think there was a lot to look forward to, and I think perhaps a lot of the optimism had sort of evaporated in the run up to the new year, as a lot of participants were expecting further um, developments in the Russia-Ukraine war. Interest rates looked as if they were going to have to go up across other major economies, but actually the start to January has been quite positive. This sort of risk-on scenario where investors favor the better returns offered by non-dollar markets, such as emerging economies, has seemed to persist, certainly in the first 3 weeks anyway. Another factor is the end of the super bull run in the US, which has seen US tech stocks really just not completely crumble, but they had a bad year in 2022 with the Nasdaq falling over 30%. Um, and I think the darling of the tech boom era is really now making way for cuts in some of the workforces in these big tech stocks. In fact, both Alphabet, the owner of Google, and also Microsoft announced some big um, job cuts, which is sort of, I guess you could call it, the new post-pandemic era, really, and they're trying to make sure they adjust their work, their headcount in that order. Okay, so factors that may impact the US dollar. Um, Interest rate differentials are key. That means How do the forecasts for US interest rates compare with those of the major economies, major currencies, I should say, that the US dollar is measured against? Another key factor is the appetite for US dollars. In a more pessimistic risk-on scenario, sorry, more optimistic, not pessimistic, what am I saying? In a more optimistic risk-on scenario, the demand for dollar wanes. So go back to interest rate differentials. If we look at what's happening in the US, I know interest rates are going to be higher in the US, peaking this year, probably a lot higher than where Eurozone rates will be, probably higher marginally than where UK rates will be, although our rates are expected to hit about 4.6%. We have another half point hike coming in the beginning of February, next week, in fact. So interest rate differentials do play their part, but the fact is market participants are saying that interest rates are not going to do quite what the Fed think, and most investors are expecting rates to soften by the year end. So the scenario, it's all sort of marginal, really, but the fact that the momentum is shifting from the US more to the European Eurozone and the UK is another factor why the dollar perhaps might be waning. Of course, the path of US inflation or any inflation is never certain. The risks to the global economy is picking up again with sorry, could be a pickup in inflation, I should say. This may happen, I guess, if Russia starts a second offensive against Ukraine in the spring, which has often been talked about. The energy shock will not be of the order of last year, which because it all came as a complete surprise. And I think this year, certainly the likes of Germany and Italy have managed to wean themselves off reliance on Russian energy. I think there's still quite a lot of energy that the EU is dependent on from Russia, such as diesel, but gradually those dynamics are changing. But I still think if there is a second offensive in the Ukraine by Russia, it will destabilize the markets. And what you've got to factor in is the unpredictability of Vladimir Putin. And I think that'll be hanging over the market all the way through Q1 and possibly half of Q2 as well. So there we go. The final currency I'd like to talk about is really sterling. The dollar is by far and away the most important global currency, but here in the UK we do like to keep an eye on sterling, and sterling fell precipitously during the disastrous and rather brief Truss administration in September, when her chancellor and she decided on massive tax giveaways that were completely um, unfunded, and which actually undermined international investor confidence in the UK. And it's the investors that the UK needs to support its current account deficit. So the only reaction, the immediate reaction, was a fall in sterling and a collapse in gilt prices, the UK sovereign debts called gilts, with the yield spiking dramatically, with the 10-year yield spiking above 6%. Needless to say, that all changed with the change in administration as the UK then embarked on its third Prime Minister of the year and its fifth Chancellor of the year as well, which is extraordinary, really. Um, anyway, what's changed? I think with the Truss administration gone, we've got a safer pair of hands with Rishi Sunak in charge. He feels very much like a sort of a caretaker prime minister ahead of a general election and the likelihood of a Labour government. Um, yeah, difficult to know. I think inflation and the path of interest rates really means that the UK is likely to be in a recession now and probably remain in one all year. I think the only bright side is that the UK equities have underperformed other international equities for years, really since the Brexit vote in 2016. And many international investors are focusing on UK assets, UK equities for acquisitions, and that a weak sterling makes the whole deal even cheaper, which is partly the reason why sterling is in demand and the reason why sterling has recovered. The other reason being that interest rate differentials here in the UK against its major competitors, the UK's major competitors in the EU and the US, are going to remain quite favorable, with interest rates here possibly topping out around 4.6%, comparable with the US, but the likelihood is that interest rates will remain higher for longer here in the UK because we've got more persistent inflation, sadly, and our core inflation is not expected to react quite so easily as those core inflations in the US and in the EU. That's it, really. That's it. Thanks very much. Bye now.